What happens when countries default on debt? Imagine for a moment a colossal financial tornado ripping through a country's economy, impacting millions and causing a ripple effect worldwide. That's what happens when a nation defaults on its debt. Today, we will be exploring this nerve-wracking topic in depth, dissecting the aftermath and revealing unexpected consequences of this catastrophic financial event. Stay tuned as we unravel the complex, far-reaching effects that go beyond the realm of finance, touching every aspect of society when a country admits it cannot honor its debt commitments. Remember, this isn't just about economics, it's a story about nations, their people, and a global domino effect. Buckle up, because we're about to take a thrilling ride into the world of sovereign defaults. Significant economic downturn. A country in default experiences reduced access to credit markers, causing interest rates to skyrocket and foreign investors to flee. This exacerbates existing financial instability and can lead to currency devaluation, inflation, and even recession. For instance, during the Greek debt crisis in 2010, the country's GDP contracted by over 25%, and the unemployment rate soared to nearly 30%. Similar effects were observed in countries like Argentina and Venezuela during their respective defaults. But it doesn't stop there. The consequences continue to ripple through various sectors and the everyday lives of citizens. Banking system faces severe strain. When a country defaults, its banking system often faces severe strain. Financial institutions may suffer liquidity crises, resulting in restricted access to funds, bank runs, and potential collapses. Depositors' savings can be wiped out, leading to a loss of confidence in the banking system and further aggravating the economic turmoil. During the 2001 default in Argentina, numerous banks collapsed and people lost access to their savings, resulting in widespread financial distress. In the case of the 2008 financial crisis, the defaults of major financial institutions in the United States sent shockwaves through the global banking system, leading to a worldwide recession. Now, let's examine how a sovereign default impacts the government and its ability to provide essential services. Austerity measures and social unrest. A default forces a government to implement austerity measures to cut spending drastically. Reductions in social welfare programs, healthcare, education, and infrastructure projects become inevitable. These measures often lead to public protests, social unrest, and a decline in the overall quality of life for citizens. In Greece, the austerity measures imposed during the debt crisis resulted in a sharp increase in poverty rates, reduced access to healthcare, and a decline in educational opportunities. Similarly, in countries like Zimbabwe, defaults on debt have led to hyperinflation, food shortages, and widespread poverty. Economic impact on trading partners. When a country defaults on its debt, the consequences are not confined to its own borders. The default can have a significant impact on its trading partners. Reduced economic activity, currency devaluation, and financial instability in the defaulting country can disrupt trade flows and affect export-dependent economies. For example, during the 1998 Russian debt default, many countries in Eastern Europe experienced a sharp decline in exports and faced economic setbacks as a result. Investor confidence and global financial markets. A sovereign default can erode investor confidence and create turmoil in global financial markets. It can lead to increased risk aversion, causing investors to withdraw their funds from not only the defaulting country, but also from other emerging markets or vulnerable economies. This contagion effect can lead to a broader financial crisis, as witnessed during the global financial meltdown of 2008, when the defaults of Lehman Brothers sparked a chain reaction of panic and instability across the world's financial markets. Long-term consequences and debt sustainability. Sovereign defaults can have long-term consequences that impact a country's ability to access credit markets and borrow in the future. Creditors become wary of lending to a country that is defaulted, demanding higher interest rates and stricter conditions. This can make it difficult for the defaulting nation to finance necessary investments, such as infrastructure projects or social programs. It also highlights the importance of debt sustainability and prudent borrowing practices to avoid falling into a cycle of perpetual debt and default. Social and humanitarian consequences. The social and humanitarian consequences of a sovereign default cannot be overlooked. A default often leads to a sharp increase in poverty rates, unemployment, and reduced access to basic services such as healthcare and education. Vulnerable populations are hit the hardest, as safety nets are eroded and social welfare programs are cut. The human toll of a default can be devastating, creating hardships and exacerbating inequality within societies. Political instability and governance challenges. Sovereign defaults can also fuel political instability and governance challenges. Citizens may lose trust in the government's ability to manage the economy and meet their needs, leading to social unrest and political upheaval. In extreme cases, defaults have resulted in regime changes or political turmoil as people express their dissatisfaction with the economic hardship caused by the defaults. International support and assistance. International support and assistance play a crucial role in the aftermath of a sovereign default. International organizations such as the International Monetary Fund or IMF often step in to provide financial assistance, technical expertise, and guidance to help countries navigate the recovery process. These programs come with conditions and require countries to implement structural reforms, address underlying economic issues, and improve governance practices. Geopolitical consequences. The consequences of a default extend beyond the domestic sphere and have implications for international relations. A default can strain a country's relationships with foreign leaders and international organizations. Creditors may demand stricter conditions, loan restructurings, or even resort to legal action. Additionally, a defaulting nation's reputation suffers, making it harder to attract foreign investment and develop fruitful partnerships. The geopolitical consequences can influence diplomatic ties, trade agreements, and a country's standing in the global community. For example, Argentina faced legal battles with its creditors, which restricted its access to international financial markets for several years. The defaults in Greece strained its relations with the European Union, leading to debates over bailout packages and austerity measures. Debt restructuring and negotiations. While a sovereign default is undeniably a dire situation, it's important to consider potential silver linings and strategies for recovery. After defaulting, a country may engage in negotiations with its creditors to restructure its debt. This involves modifying repayment terms, extending maturities, or reducing interest rates. These negotiations aim to provide some relief to the struggling nation and pave the way for eventual recovery. For instance, Greece underwent multiple debt restructuring agreements to ease its financial burden and regain stability. Similarly, countries like Ecuador and Ukraine have successfully restructured their debts in recent years. Lessons learned from history. Throughout history, sovereign defaults have taught us valuable lessons. They emphasize the importance of responsible fiscal management, transparency in economic policies, and the need for effective regulation and oversight of financial institutions. Additionally, they highlight the importance of diversifying the economy, reducing dependency on external borrowing, and building resilient financial systems that can withstand shocks. Case studies of recovery. Now, let's discuss some real-world examples of countries that have faced the challenges of default and managed to bounce back. Argentina, for instance, defaulted on its debt in 2001, but eventually reached agreements with its creditors in subsequent years. The country embarked on economic reforms, re-established credibility, and experienced periods of growth. Iceland is another noteworthy example, bouncing back from its 2008 financial crisis through a combination of debt restructuring, currency controls, and fiscal discipline. This case demonstrates that with the right policies and perseverance, recovery is possible. However, the road to recovery can be long and arduous, requiring a commitment to structural reforms and responsible fiscal management. The road to recovery. The road to recovery after a sovereign debt default is challenging, but it is not impossible. Countries that successfully recover from defaults often undertake significant economic reforms, including fiscal discipline, debt restructuring, and structural adjustments. They prioritize long-term sustainable growth, promote investment, and rebuild investor confidence. Recovery requires the concerted efforts of governments, citizens, and the international community working together to overcome the challenges and lay the foundation for a stronger and more resilient future. Well, a sovereign default is a complex and multifaceted event with far-reaching implications. It affects not only the economy of the defaulting country, but also its citizens, international relations, trading partners, investor confidence, global financial stability, social welfare, and political stability, etc. The consequences include economic downturns, financial sector disarray, social unrest, strained diplomatic ties, challenges for debt sustainability, and humanitarian crises, etc. However, history has shown that recovery is possible through negotiation, structural reforms, international support, and a commitment to fiscal responsibility. By learning from past defaults, implementing preventative measures, and fostering international cooperation, countries can strive to build a more stable and resilient global financial system.